What is going on YouTube? Today we are going to be talking about the looming credit crisis. This is a contagious debt problem starting in the US and expanding outwards. It is going to be an integrative analysis looking at fixed income assets, personal spending, inflation, yield curve control, everything. I'm just an autistic person in a basement forecasting a black swan. There is a high probability I am wrong, but I'm going to be talking about how I'm positioning, how this could affect riskier assets like crypto, and ultimately what is going to be the resolution to this massive debt problem. And what you're going to do for me is you're going to subscribe to this channel, stick around until the end, and let me explain. The first thing that we are going to be talking about is boring old bonds. These instruments are absolutely foundational to modern finance. They have become incredibly complex as yields have been rising, and there is massive consequence to exactly that. We're going to be talking about how money managers are playing this trade, how countries are playing this trade, who's buying, who's selling, and what you can do about it. What you're going to do for me is you're going to like this video and let me explain. The American banking crisis was less than 12 months ago, but we seem to have forgot about it. The largest banking crisis of all time was Washington Mutual, where in 2008, 307 billion assets were at risk. Since then, May 1st, March 10th, March 12th, all 2023, 212 billion, 209 billion, 110 billion. What does that add to? 521 billion. First Republic, Silicon Valley, Signature Bank, all liquidated in 2023, but people seem to have forgot about it. And that is a great question. How did the Federal Reserve fix it? The Federal Reserve fixed it by creating a new credit facility called the Bank Term Funding Program. Essentially, they're loans that don't need to be paid back, more or less, by and large. And the unit of denomination here is millions of dollars. And so if we recognize that $1,000 million $1,000 million is $1 billion. The base unit of denomination here is millions of dollars. So right now there is $147,175 million or 147 billion floating around essentially in loans that really don't need to be paid back. This is from the Federal Reserve's website, and if I zoom this window all the way out along the bottom, you can see this program literally didn't exist until the credit crisis of March 2023, which, I mean, in my opinion, pales to compare to what is coming. The next thing I want to point out, the Federal Reserve total assets less elimination from consolidation is basically their balance sheet. So same thing, the unit of denominations, millions of dollars. 1,000 million is a billion. Right, so here we had a Federal Reserve balance sheet heading into the global financial crisis of 417 millions of dollars, which is basically like what, 880 billion. Top of the bubble, it reached just over 2 trillion. So that is the size of the Federal Reserve's balance sheet, and essentially that's mortgage-backed securities, right? A primary thing that they buy is bad debt. That's bonds, and more recently in 2020, they started buying individual stocks as well as index funds. Scary. With the March crisis, we went from a $4 trillion Federal Reserve balance sheet all the way up to $9 trillion. For reference, $9 trillion, that is more money than was required for the US dollar's survival for 200 years. Sorry, the change from 4 trillion to 8 trillion or to 9 trillion, that is more money than existed in the entire US dollar's history until the year 2000. To put in proportion, like the rate of acceleration. So basically, the higher this goes, the more the Federal Reserve is printing. So when this number is going up, that is quantitative easing, and when this number is going down, it is quantitative tightening. As you can see, this tune began to change. January 2022 is when we began to see a bit of a downtrend, and that is when interest rates were rising and quantitative tightening began. Like I said, I'm going to make mistakes. Sorry to interrupt. I just wanted to remind you that we have a Discord community that is completely free, full of like-minded and highly intelligent individuals. You can find it in the description or at discord.dg/learn to earn. I'd love to see you there. We're doing this in one shot. Another thing that you need to be aware of is repurchase agreements. So repurchase agreements are essentially essentially, let me read the official definition. Repurchase agreements reflect some of the Federal Reserve's temporary open market operations. They are transactions in which securities are purchased from a primary dealer under an agreement to sell them back. So imagine if you needed liquidity, you had to buy a car. So you go to your parents and you're like, well, shit, you take my fancy computer, you give me cash, and then I'll pay you back cash plus interest, and then I get my computer back. That is essentially what people are known as primary dealers, i.e. shadow banks and depository institutions. They take US Treasury bills, they give them to the Fed gives them cash, they go make their speculatory bets, they go pay their margin calls, they go distribute liquidity, whatever. They give that money plus interest back to the Fed, they get their securities back. It's basically a short-term liquidity program. And so when people need liquidity, repurchase agreements go up. So you could see the rate in 2008, it went up. Banks needed liquidity, so they're giving T-bills to the Fed. March 2020, repurchase agreements reached a high. Again, millions of dollars. It reached let's see if I can snipe this. So that means the all-time high for repurchase agreements in a single day. In a single day was 441,945 millions of dollars, i.e. $500 billion. Insane. But now there's what's called reverse repurchase agreements, which are basically the exact opposite. So in this instance, imagine you have too much money and you're like, well, shit, I got to make some money on it. So how can we do this? So what they do is they take their lump sum of cash, they give it to the Federal Reserve, and they're like, hey, you hold on to this. The Federal Reserve is going to take that cash, offer them interest, and then pay them back in the future. So it's basically like ultra short-term savings account. And so when banks have too much liquidity, this is what they do. And so this should make you think, why did this number go so high post 2020? Why? Think about it. What happened post 2020? The banks, we just looked at this. The banks were printing money. The Federal Reserve were printing money, buying bonds. And who did they give the bonds to? They gave the bonds to the bank. Well, now the bonds have excess liquidity. So the bonds give those bonds back to the Federal Reserve, who guarantee interest. Next question, how much interest do they get? Right here, interest rates during the same time frame were pretty much 0.05. That is an annualized rate. So they were making fractions of basis points. But because the Federal Reserve was pumping out so much liquidity, there's literally nothing else to do. So in this instance, we have a situation where the Federal Reserve is holding a whole bunch of assets. Banks are holding a whole bunch of assets. And now because interest rates have been rising and rising, those assets are becoming worth less and less. Ultimately, we are in a situation where banks are on hundreds of billions of dollars of unrealized losses in securities. These are all on bonds. That's what the Federal Reserve did. Them and the US Treasury partnered up. They bought bonds, they gave them to the banks, and they said, don't worry, it's cool. The value doesn't matter. They are called HTM, hold to maturity. This makes them immune to what is called mark-to-market accounting. So let's say you have something that's worth $100. You are told that you don't need to take the real value of it. So you always think it's worth $100. Well, shit, you need some liquidity. You go to sell it. Turns out it's only worth $20. So the mark-to-market value is $20. The hold-to-maturity value is $100. And so in this instance, banks are sitting on massive losses. This article is from October 17th, 2023. Bank of America's unrealized losses on securities rose to $131 billion. Just Bank of America. There is another article here. Not that one. Maybe I don't have it open. The total bond losses of the American bonds. Let me find this actually. Never mind my keyboard clicking. Let's see if I can find it. I can't. Oh, there we go. Banks' hidden losses are surprise survivor of 2023. Reuters article, reliable source. Let me scroll down until I find it. Bear with me, guys. Bear with me. It is over $500 billion in unrealized bond losses, and it is all available. There we go. Banks in the United States had 684. Let me zoom in here. $684 billion of unrealized losses on their securities investments in the end of September, a 22% increase of the preceding quarter. The higher the yield of bonds go, the lower the price of previous bonds, right? So effectively, the Federal Reserve has made everyone insolvent at the same time that they're giving out liquidity. This banking crisis that we saw in 2023 is the direct consequence of the Federal Reserve raising rates. And so from this perspective, fixed income is fucked. And remember, I am not a financial advisor. I'm a degenerate. Towards the end of this video, I'm going to be pulling up the charts of the SPY, the NASDAQ, the Dow, etc., tying this entire thesis into crypto and what my expectations for the coming, I would say, 3 to 6 months are. The fun thing about interest rates is the higher the interest rates go, the more interest you pay. Not only does that make my mortgage more expensive, it makes the government's debt more expensive. Because if we pull up the handy dandy US debt clock, we are going to see that the US government currently has over $34 trillion in debt. And what makes that really fascinating is not only is that a lot of debt? That is a lot of interest. And so, for example, the US interest payment on federal debt versus defense spending. In 2023, they spent more money on the interest on their debt than their entire defense budget. The higher rates are, the worse it's going to get. And rate cuts, we'll get to this, are bearish. The US government is suffocating themselves in debt, and this is manifesting themselves in the bond market. America's biggest bond buyers aren't buying bonds. They are having trouble finding counterparties for their auctions. When you can't find a bond at a specific price, you have to offer it at a higher yield, right? You have to make it more appetizing, plain and simple. Things are different. People don't want US bonds. They need to protect their own currency. China is a great example of this. China's holding of US treasuries is the lowest since 2009. Clear downtrend. Yes, they are trying to defend the yen, but this is happening at a multinational level. People are ditching the dollar to protect their own currency. So people not only aren't buying bonds, people are selling bonds because they know they can get a higher yield elsewhere. This is manifesting itself as a credit rating. Moody's and other significant rating agencies have lowered its US ratings to negative, right? It has removed its quadra A status and set them to triple A. Moody's on Friday changed the outlook of the government US America's ratings from negative to stable. One more thing that I want to point out. This is the yield curve. The yield curve is basically a complex instrument. So I'll explain it. The bottom is the maturity. So for example, on the left-hand side, we have short-term bonds, the 2-year, the 4-year, the 6-year, the 8-year, the 10-year. These are actually technically called notes. When you go to your long-dated bonds, the 12, the 20, the 30, etc., these are true bonds. The short-term bonds shouldn't pay more than long-term bonds. If I loan you money for a month, that should pay less interest than loaning you for 30 years, right? If I loan you money for 30 years, that should pay you more interest than a short-term loan. But fact of the matter is that this is what the yield curve should look like this, right? If I loan you money for 4 years, that should pay you less than 10 years. If I loan you money for 10 years, that should pay less than 24 years, etc., right? This is what you call a healthy yield curve, while what we currently have is called an inverted yield curve. Yield curve inversions are hallmark of recessions. So right now, short-term US treasuries are paying just under 5.5%. What has to happen here is called YCC, yield curve control. So effectively, what needs to happen here is short-term. Let me grab my handy dandy. Actually, no, I'm not. So basically, the short end of the curve has to correct. Short-term yields have to come down. Long-term yields have to come up. Like we talked about, the price of a bond and the yield of a bond are inversely correlated. So if we operate on the assumption that short-term yields have to come down, well, short-term bond value has to go up, right? If we want yields to go down, price has to go up. And this is what, I guess, portfolio managers call the short end of the curve, right? I don't really think there's a formal definition for the short end of the curve. For this, we'll call it less than 10 years, for example. So Stanley Druckenmiller talked about this in a recent podcast. But SHI is a great example. SHI is an iShares 1 to 3 year Treasury bond ETF. In theory, this has really high upside because yields have to fall substantially, meaning the price of the bond is going to go up substantially. They are inversely correlated. Yield curve control. That is a very crowded trade amongst portfolio managers because everyone knows this literally has to happen. A less crowded trade is playing the 20 plus years. That would be evident in something called TLT. TLT does have higher upside, currently trading at 95, peaked at 164 during the C word crash. But this is a great example of how yield curve control is a speculative opportunity. That being said, I would not recommend trying to capitalize this, but that is something to keep in mind, and that is exactly what portfolio managers are doing. An easy way to conceptualize how the bond market can lead to a recession is looking at 2 and 10-year spreads. So you take the 10-year yield minus the 2-year yield, you take the difference, and effectively, so you see this period at the bottom where it was negative. When it is negative and it becomes positive, that is before a recession happens. When it is negative and it turns positive, a recession. When it is negative and it turns positive, a recession. Because that is basically your yield curve was inverted and now it's not. That is what a negative to positive 10 and 2-year spread is. So our 10 and 2-year spread is currently very negative, but rapidly correcting as the bond market normalizes, and this will speed up even quicker as the Federal Reserve cuts rates. Hopefully you learned something because the next thing that we are going to be moving on to is inflation. We're going to be talking about different inflation metrics, the Federal Reserve's preferred measurement of inflation. Is it actually working? We're going to be looking at expenditure and just how broke the average consumer is. We're going to take a deeper dive at debt levels, what people actually owe money on, and what this means for you. The Federal Reserve's job is not done yet, though. Inflation is still sticky icky. And part of the reason why inflation is still icky is because of energy. OPEC, for example, Organization of Petroleum Exporting Countries. So we're looking at Saudi Arabia, Russia, UAE, Iran, Venezuela, etc. They are voluntarily agreeing to cut oil prices. If you reduce supply, price goes up. This makes inflation worse. To me, to some degree, I think this is economic warfare. Other metrics to consider that inflation is not gone. Cocoa prices are up 65% this year. Orange juices are the highest performing asset since the year 2020, far and away above outperforming any tech stocks. Inflation is not gone. The funny thing about the CPI calculation is they refine it every, I think it's 2 or 3 years, and they can conveniently remove what has high inflation. They conveniently add what has low inflation. This is what is called data set skewing. They never really tell you what's in the CPI calculation, but I will tell you there is 2 measurements. There is CPI and there's PCE. CPI is generalized inflation and PCE is the same calculation but without food and energy. Well, shit, we just showed that energy is expensive and we just showed that food is expensive. So although those numbers might be coming down, justifying a rate cut, from our end as a consumer, prices haven't come down. In fact, they are higher than ever. I am not joking when I say everyone is poor. This is a chart that is slightly cut off, but it basically just shows the level of student debt, the level of debt and the rate or probability of delinquency. So student debt has the highest probability of delinquency because these individuals, as assessed by TransUnion, have the lowest level of income proportional to their expenses and the highest level of debt. Student loan, credit cards, retail, personal loan, car loan, real estate, blah, 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 blah. October data shows weakness in retail sales after student loan payments restarted. So, student loan payments were kicked down the can. Thank you, Joey. As part of the pandemic plan, they restarted in October. Since then, month over month, retail sales down. The economy is just a reverse pyramid. Reverse pyramid, right? Sorry, no, it's a pyramid. You have sales, right? Sales contribute to businesses. Businesses contribute to corporations. Corporations contribute to the market. It takes time to filter up, right? It's a food chain if you really think about it. The other interesting part of this is as rates go up, it takes time for that to actually get baked into the economy. The interest rate on existing US loans is far below far below the benchmark rate of lending. The benchmark rate of lending in the US is 550 basis points, which is right about here in the middle of the chart. It takes time for all of these loans to get recalculated at higher rates. So if you sign a 4-year mortgage in 2019, you won't get reassessed until 2013, right? It takes time to get baked in, and this contributes to what is known as over tightening. We'll get to that. Stick around. We're getting to the meat and the potatoes. 63% of all mortgages outstanding were issued after 2018, right? Rates were cut to zero with the pandemic, and people took on an absolutely disgusting amount of debt because there was nothing better to do. Rates were low. Fuck it. Let's buy a house. That was a very crowded trade in Canada. An easy way to visualize just how poor the average household is, this is American debt, but instead we've pivoted. Before we were billions of dollars as our or millions of dollars as our y-axis. Now we are billions of dollars. Incredible. So there is currently over $1.029 trillion of what is called revolving plans. So this would be high interest credit cards, lines of credit, stuff like that. Mortgage applications to buy a house are at the lowest levels since 1994. People cannot afford high rates, let alone people getting refinanced at high rates with inflation this high and compensation proportionally so low. Let's see. I just want to make sure. Real estate is actually considered a bad investment. And the reason is the single family cap rate, which is the average rate of return less expenses on an annualized basis for a piece of property, is around 4.4%. 6-month treasury yield is rapidly approaching it. This is an old graph. There is an updated one. I guess I don't have it handy. Fuck me. But what I'm going to tell you is in the updated one, 6-month treasury yield is above cap rate. That means without accepting landlord risk, property risk, debt risk, etc., you can get higher yield on a fixed income instrument than real estate. That highly incentivizes less speculation in the real estate market. Quick breath. 30-day delinquency rates by property type, essentially everything is going up because when you look office space, well, I mean, who the fuck's renting office spaces? The commercial real estate ecosystem is completely defunct after COVID, right? Everyone wants to work from home. Nobody wants to go to the office. Let me quick check. Oh, whoops, didn't mean to close that one. Oh, well. And that's just about all I have to share. But now we're going to talk about the market, how this is going to manifest in price action, and what comes next. Lastly, and probably most importantly, we're going to be talking about the actual market itself, the SPY, the Dow, the NASDAQ, etc., and specifically how this could affect crypto and what I am doing to position for this. Like I have said before, long until wrong, don't stand in front of a moving bus. But here are some interesting manifestations of these economic problems in markets. US is near extreme peaks versus global equities, well exceeding the 60s and 70s tech bubble. So the tech bubble is this little blip in the middle. This is basically, I guess, valuations, nifty 50s, internet bubble, and this is where we are for US versus global equities. In the Magnificent 7, 5.4x as much equal weight in the NASDAQ since January 2020. So essentially, this is saying that the Magnificent 7 are composing 5.4 more weight in the NASDAQ compared to 2020. What does the Magnificent 7 actually represent? Microsoft, Meta, Amazon, Google, Nvidia, Tesla, and there's one more, but I have dementia. Apple. That's what it is. Apple. That's what it is. So basically, the theory here is that all of these flows, let me open up a new trading view tab here, are just moving into the same 7 companies. More concisely put, there is a strong argument that from the year 2023 until now, when these have rallied over 123%, while the rest of the market, as measured by the SPY over the same time frame, is only up 25%, strong case to be made that all of these gains are being piled into these select few tech companies, resulting in a very crowded trade. And this is what is called breadth. Breadth is when you take an index and you look at the highest performers, Nvidia, versus the lowest performers. When there's really high breadth, that is a cardinal sign of an unhealthy market because it skews the index up, but it's not actually the index doing well. It's just a few companies. You can look at this. There's articles just about everywhere on the Magnificent 7, but to visualize it, The orange line here is just the Magnificent Seven, so Apple, Tesla, Amazon, Google, Meta, Nvidia, and Microsoft. While this orange line is the SPY without them, right? Look at that performance difference from 2023 until now. SPY without the Magnificent Seven and the Magnificent Seven far above it. This is very high breadth. And despite this, we are actually sitting on trillions of dollars in money market funds as people collect that risk-free premium. And so now we are going to speculate on what comes next for these markets. I'd also like to insert a little blurb saying I might be bearish on the economy, but markets and economies are entirely different, right? They are not necessarily always correlated. Markets can go up when the economy is shitty, and markets can go down when the economy is great. It's just the way it is. But what I'm telling you is sometimes they become in line, and that is when you have to pay the most attention. And so what I am saying is that although the economy is shit, I'm not necessarily actively shorting the market. Long until wrong is the time proven best strategy of all time. Using our handy dandy CME FedWatch tool, we can visualize different probabilities for Fed rate cuts. So these show let me accept all cookies. These show all of the Federal Reserve meetings. So January 31st, 2024, with 96.9% certainty, they're expecting a rate hold. But coming March 20th, 2024, right, January, February, March, the third month of the year, with 54% certainty, they're expecting a rate cut as soon as March. Looking at this chart, very overwhelming, but I'll break it down. The green line is when rates start to get cut, right? In the year 2000, it happened in around June. In the year 2006, it happened in July, right? This is when rates begin to get paused. Green is pause, red is cut, and the white is the SPY bottom. So looking at the year 2000, from the time rates are cut until the market found its bottom is 852 days. From the rate cut until market bottom was 669 days. That was the year 2000. Global financial crisis, you will find that it was 914 days between pause and bottom, and it was 609 days between cut and bottom. Looking at the March crisis, March 2020, it was 455 days from hold until bottom, and it was 245 days until cut from bottom. So we have had rates held for how long? 184 days as of right now. So the golden question is, if rates get cut in March, how quickly will the markets react? How quickly will they begin to price this in? Because on a historical level, the equity markets tend to draw down, and this is what is known as over tightening. Like I said, it takes a while for interest rates to get baked into the economy. It takes a while for the consumer to feel the pinch, which manifests as low business income, which manifests as poor earnings reports, which hurts the index, right? It's like a food chain. It takes time for the top feeders to actually feel the pain from the bottom feeders. And so it is my belief that not only are banks virtually completely insolvent, not only are individuals completely insolvent, our country's completely insolvent. All of this is going to come due sometime in 2024. My best guess would be Q2. But it's interesting to see such a systemic level or such a systemic issue on each level of the food chain, right? The retail, the business, the corporation, and the government are all virtually bankrupt. To get more specific with what I see in actual equity markets, this is the dollar DXY, the US dollar currency index. We had a successive series of lower highs, right? One lower high, two lower high, three lower high broke. And the dollars and risk on assets basically more or less by and large have negative correlation. So from October until now is when crypto has been doing really well. This stretch right here. And this stretch here is when when stocks and crypto were hurting a bit more. So now the dollar kind of looks like it's about to rip, right? We had a successive series of lower highs. With this push here, we put in a new multi-year high, and we have come down and basically confirmed that the 100 level is support. Obviously, the DXY is a dollar index, so you can't really predict what's going to happen in foreign exchange markets, but it seems likely the US dollar isn't going anywhere anytime soon, right? BRICS is not as ahead as some people might make you out to believe. So personally, it seems like the dollar is in a position to rip, and if the dollar is in a position to rip, then we need to be risk cognizant. Right, so that is what I think of the dollar. The Magnificent Seven is just an absolute price discovery. frankly, I mean, 2023 until now, fucking best trade of the year, 130%. It would kind of make sense that if we see some turbulence, could maybe see it come down. But what's important is when all of these gains are concentrated in a small amount of companies, when they begin to fall, the index will fall faster, right? Because they introduce a positive skew. Right, they introduce a positive skew. So if the Magnificent Seven start falling, the index is going to fall faster, right? Because they compose such a significant portion of it. So SPY did reach an all-time high, absolutely insane. I guess for short term, 4,600 would make sense, right? Kind of retest the previous high. But if we're talking this like banking insolvency crisis, it would be a pretty significant markdown, right? Because essentially there was going to be a series of margin calls. This is now the weekly chart. And if we were to see some turbulence, which I mean, I guess a counterpoint to this to kind of challenge my own thesis is that next year is an election year. Not next year. This year is an election year. So I don't know, drift up a little bit. But if the bill becomes due, 30% down would put us at 3,500. 30% down is a nice like number. I mean, like the March 2020 crash gave us 30% down. 2007 tip to tail 55%. That's actually more steep than I thought it was. .com was 50%. So I guess maybe this is just proof of QE working, right? Crashes happen. Instead of avoiding the 50%, financial engineering protects us, right? Protects us. So in the event of some credit crisis, 30% on the SPY seems reasonable. Low 3K. The Nasdaq definitely has the furthest to fall because again, all of these gains are concentrated in tech stocks. And the Nasdaq, if you did not know, is the amalgamation of all the tech stocks. In 2020, the Nasdaq drew down 32%, and again, it drew down in 2021. What is that, like 38%? I don't know. Absolutely insane. Nasdaq's a lot harder to forecast, but I think ultimately if we were to have some kind of large scale credit event, it would probably fall a bit further, maybe back down to the key, nice round number at 10K. And like I said, guys, it's not like I'm actively shorting the market. I think it's just good to be cognizant of the downside because at the end of the day, we are up shit's creek without a paddle. The Dow is boring. Don't need to look at that. Actually, I mean, I guess just purely based off technical levels. Let me delete that. The the 2020 high here, March 2020 high was the convenient bottom of October 2022, which puts us at a 22% drawdown. The Dow doesn't contain as much volatile prone stocks. I guess you could say it's a bit more robust, lower volatility. Gold's been trending. Silver is okay. I don't know. At the end of the day, obviously being a bear makes you sound like the smartest person in the room, but I'd rather be prepared than surprised, right? One other thing that I wanted to include in this video, I've talked about it before, but this is gold in 2004 when the gold ETF came out. No surprise, it pumped the month of announcement. It went up to, let's see, let's go tip to tail. That's 3.5%, which for a commodity, pretty good. No, sorry, never mind. This is the weekly chart. We're going tip to tail, 11%, pretty good. But if you take the tip to the tail of the month following, specifically 42 days, there was a 14% drawdown, right? So the announcement was the second week of February. So we drew up, we set a high, we came down. Useful mental model to compare because the ETF is the same, right? It increases accessibility. It creates a more liquid market. There's now options available to be underwritten on that ETF. But when you look long term, that ETF went up only. So like I've said on my streams and like I've said in my analysis time and time again, the ETF was going to be a pump, a dump, and then a pump. That's the way I see it, right? That's just the way it is, right? The ETF for gold in 2004 is a useful mental model. As for gold, is now trading at $2,000. Hard, I don't know. At this point, like gold was meant to do really well when inflation was hot and people wanted to store value. So in the event that we do get some credit crisis and people want to store money under their mattress instead of a bank, to me, high time frame look, right? We used to have sellers at this 2000 level pushing price down, and now frankly, we have buyers, right? They push the price up of gold to 21.48 as the swing high. So from a technical analysis perspective, it actually does look pretty good. Speculating what this could mean for crypto is really tough because crypto is basically as far out onto the risk curve as possible. Obviously, we have had a very euphoric crypto market so far. The next halving is in April 2024. So let me put a white vertical line there. Honestly, a crash before the halving would be a blessing. Get that opportunity to stack cheap. But it really depends on just how bad this systemic banking crisis goes. To me, realistically, it wouldn't be out of the picture if things get really bad that we dip below 20K and we get an opportunity to stack cheap again. I would buy a ridiculous amount if that was the case. But I think it is important to note that crypto is just an extended version of tech, right? It's just further out on the risk curve. It is just a riskier version. It is not an acorrelated market. It is the opposite. It is a highly correlated market. And so if we are going to see a major drawdown in US market indices, crypto will draw down. And just to be a little bit more specific with my Bitcoin thoughts, yes, I recorded the next day. Yes, I changed my outfit. We have a series of higher lows, right? Nice and easy to understand trend line. This swing high at 49 was on ETF day, but guess what? Buy the rumor, sell the news. Who could have seen that coming? From a market structure perspective, this was absolutely devastating, right? Failed the retest here. And the way I see it is pretty simple, right? We have an ascending triangle, fake out, break to the downside. From a market structure perspective, this right here and this impulse move, this is a lower low, and this right here is a lower high. With this wick down, on the Binance market, we have put in a 31-day new low. And personally, I do not think that the 40K support is too solid, right? When we look at what this 40K support actually substantiates, it was just a whole bunch of wicks over here, right? It's a nice psychological number, do not get me wrong, but I think from a technical level, we haven't seen too much price action history here. So to me, the kind of end all for the long until wrong strategy is 38K, because when we zoom out, 38K is the key level to watch. Past 38K, we are up Schitt's Creek without a paddle. So my long until wrong bias is maintained until 38K. And should that break, honestly, the 20s seem likely. Pre-halving all-time high, just to explain this thesis, the pre-halving all-time high would be max pain for just about everyone in the crypto market, including myself. I am not positioned for that, and I will openly admit it. The halving is meant to be on April 18th, I think. So put a nice white line right there. Max pain would catch everyone off guard is a pre-halving blow off top led by Bitcoin. Non-zero chance that it happens. I do not think it is the likely option, but worth thinking about because that is max pain. So personally, I think we're probably going to start heading into the 30s pretty soon. Obviously, 40K is a key level. If we see a big infusion of spot volume, maybe we see OI start to pick up. Because when we hop over to Velo data, there is absolutely nobody bidding. Velo data is a great tool for this. We want the futures button over here. Futures, market, there we go. And as you can see, funding APR heat map, we can do funding. Let's stick with large cap, and we want to look over the last month. So if it's yellow, that means that there was a very high premium to long the asset because there was a large amount. It was a very crowded trade, I guess is the way to say it. And so if you see yellow transition to green, that means there's a decreased number of bidders. There's decreased interest in this trade. So this covers everything. This covers Bitcoin, Ethereum, ICP, Stellar, Near, Matic, Link, Caspa, HBAR, everything. And so this is substantial evidence that we are not seeing the same volume that we were before. The other thing that I want to highlight is Velo data can aggregate all of the spot volume. And when we look at the spot volume, the push that took us up above at a relative price point, sorry, that's Ethereum. The push that took us up to a comparable price point, the volume is just not there, right? These green bars here, oh, sorry, that was a very sloppy circle. These green bars are very high volume. That was ETF day. But now we are trading with much less volume at the same time that when we put the OI in dollars, right, OI is trending down. Funding rate also flattened, meaning people are starting to be cognizant of the downside. So overall, open interest is still substantially high. We can look at that on the futures tab. Maybe not, maybe the market tab. Oh no, there it is. Bitcoin open interest, still over $7 billion. But when we click on the market tab, like I originally meant to, total open interest is over $20 billion for all coins, which if you look on the 1 year perspective, still substantially higher. So I think if we do see some cascading liquidations to the downside, things will get sticky as the longs get squeezed. So ultimately, as was my thesis detailed on stream, the ETF was a sell the news event, up the day, down a month after. So personally, it seems likely we're going into the high 30s to at least test if we do have any buying interest here. The last thing I'd like to tack on for Bitcoin is looking at our indicators, right? Our barometers for risk. So the 13 and the 21 EMAs just crossed for the first time, and the last time that they crossed was all the way down here at $26,000 per Bitcoin. The 13 has been above the EMA since that point in time, which resulted in what? That is like 86% move to the upside. So that is one data point to be aware of. The EMAs have done very well in this market context. Something to be aware of. The other indicator that we like is the Laurentian classification, an artificial intelligence script, which has been long since, what is that? That is like 26K also. Big move to the upside, just flashed a red signal. We're going to do this on the daily and the 12-hour. The trend trading bot designed by yours truly did also like the price action at 26K, and it's like a point of last ditch before it would flip bearish is 39.2. 39.2. So the other two indicators can't quite forecast like that. With the 12-hour in mind, it did recently flip bearish. Let's check on our Laurentian classification, also bearish on the 12-hour, while our EMAs have been basically red since 45K on the 12-hour. So we are basically getting some bearish confluence from our indicator system. And that being said, I never use these indicators in isolation. They provide more context to what market structure is telling us. Anyways, just to summarize all the points, I think being cognizant of the downside is worth it, right? We just had one of the best years of performance in broad market indices, whether you're talking about the SPY, the NASDAQ, Bitcoin, the Dow, etc. Changes are coming. What has worked in the past will not work in the future, right? We went from low rates to high rates, and it is likely we are going back to low rates. To put myself out there, my prediction is that we are going to have a large credit event between now and the end of 2024, resulting in a major drawdown. Interest rates get cut faster than expected. The soft landing is not achieved. Money is printed, and we enter the inflative cycle of the dollar where it loses its strength. Might seem crazy, but let me know what you think in the comments. Take care. Thank you for watching. Remember, this is not financial advice. I'm just speculating on what the downside could be. I reconsider my long until wrong thesis between 38 and 40K. If we do get some kind of bounce price action, that would be when I consider shorting. I have puts on Bitcoin and Ethereum expiring in both February and March. But ultimately, I think if we were to get a pretty significant markdown in price towards the high 20s, the low 30s, I would mainly be looking at alts and Bitcoin. At this point in time, I'd feel pretty comfortable ignoring Ethereum. Of course, depends on the ETF. That is a pretty compelling narrative, but as always, depends what the market tells us.